Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
I was speaking to Peter and Susie, and Peter had reached the magical age of 70 and a half years old. Peter and Susie are very involved with their church and believe in tithing and contributing to the church. And in their case, they were giving $7,000 a year to the church out of their income. The difficulty with this situation is they were not able to take a deduction for this because the standard deduction with what it has gone to of roughly $25,000 for a couple was high enough to compensate them, and they were not able to itemize. In finding this out, in speaking to them, I let them know and inform them because they didn't know what they didn't know. I helped them to understand that if they took that $7,000 a year out of Peter's IRA and sent it directly to the church, then they could put the $7,000 they were paying into their 401k or keep it or whatever. That $7,000 that was coming out would be tax-free. And if you are 72 years old and have to take the minimum distribution, it counts toward the minimum distribution. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about if it's tax-free, it's for me. And Dad, that is certainly a way where people can take money out of their IRAs tax-free, which is pretty cool because, like you said, that pesky age 70 and a half, which now has changed to 72 years old. But you have to take money out. So people will say, well, who cares? I don't care if I have to pay taxes. I got, that we're just using that number, $1 million in my 401k, my IRA, who cares? Well, a lot of people don't know that if it's in a 401k, it depends on the plan, but a lot of them, when you pass away, it just all becomes taxable. Right. And so a lot of people choose to control their taxes by rolling those into an IRA because it gives them more ability to do things like this QCD, where they give their RMD to a charity and it just comes off their taxes. That distribution doesn't even go on to the taxes as opposed to doing a deduction. So this is a little confusing for people. And that's why we have that paper we're giving away, because it spells it out very nice. But also if you're part of a charity, this is good for you to know because boomers, are in that age and they're starting to have to take this money. They have a lot of money. And if you're in a charity, you can do two things to get tax-free money and to help people that want to save money on taxes. One is you can tell them about taking RMDs and sending them to the charity. And that helps these hopefully charities that are doing wonderful things, right? Food pantries are a big thing. There's a lot of people starving in the US right now.
That's right.
And so that's a thing. The other is you can set up accounts as a charity where people can donate their stocks right to your organization. And then you receive that money and they don't have to pay taxes on those stocks that they may have big gains on. And so those are a couple of ways to get tax-free money as well.
Yeah. And what the story that Daniel mentioned, QCD, that stands for Qualified Charitable Distribution. QCD, Qualified Charitable Distribution. That's the story that I started the program with. And that is available if once you reach 70 and a half years old, even though they made RMDs at 72 years old, they kept the QCD at 70 and a half. So if you're 70 and a half years old, you're able to do that. And in an example of Peter and Susie, like I gave, they can actually, because Susie's still working, they can contribute either to an IRA, that $7,000 they could contribute to an IRA, or they could put it in Susie's 401k plan. And if they did that, that's going to save them $1,400 of taxes right now from that standpoint. So actually, they are able to still give to the organization the $7,000, and they're able to keep $1,400, put $1,400 back into their pocket. So it's quite interesting. And then what Daniel is saying in regard to these stocks that have appreciated, you give them to an organization and you're able to take a tax write-off from that standpoint and be able to save money on that. So that there's various ways of being able to do that. But I want to remind you that you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. So we want to inform you of that. Today, we're talking about if it's tax-free, it's for me. We hope you're getting something out of it, and like your feedback one way or another on that. So if this is good, let us know. If we're not hitting the points or missing something out, help us to get better. We covet your help on that. 800-725-7616. You can let Megan know when you call what your input is on that. But we also have the piece that talks about these QCDs, qualified charitable contributions, how to give and receive charitable contributions. So if you want that, ask Megan for the white paper, the report on charitable contributions. And you're listening to Financial Strategies. Today's topic is, if it's tax-free, it's for me. Listening to Daniel and Andrew Agemy. So, Daniel, what other tricks, whatever options do people have? I mean, you mentioned earlier that, we're in the time frame before April 15th, where people can contribute still for 2020 if it's appropriate, and can also do it for 2021. So we want them to let them know that, right? What else can we give our listeners today, or should we maybe recap, because taxes are going to be increasing and we want them to save them taxes?
Well, in case we haven't convinced people yet that taxes will be going up, I'm going to bring something to their attention that is extremely sobering. And this is that the published U.S. national debt is $28 trillion. Now, every president has doubled the deficit since Clinton. Okay, Clinton was the last person who he didn't double it. Everybody else has doubled it. We're running $1 trillion deficits without COVID. Okay, now that's the published, but the actual liabilities, when you count Social Security and Medicaid and all these kinds of things that the government has, it's really $139 trillion. Wow. So to put that in perspective, that's $906,000 per taxpayer.
Wow.
900. So your tax liability is $906,000 if you're a taxpayer. So we can pretty confidently say taxes are going up. And that's why this is such a big deal, to look at your plan. Do you have a plan? Do you have a plan for creating tax-free money? Do you know about these things we were talking about? Do you ask your tax preparer each year, because we're coming up to taxes, what can I do to save money to get tax-free money? Now, a lot of times tax preparers won't tell you how to invest your money. You should do this or that or the other thing, but they can look at the numbers and they can tell you, hey, if you make this contribution for 2020, it will bring you down to a lower bracket, or you have, this much room where you can move money from your IRA, from your 401k into a Roth IRA, and it won't push you into another bracket. That makes a ton of sense for a lot of people. So if they're not having these conversations with you, then you need to find somebody that will have these conversations with you, because this is vital. We talk about you can't compound money if you're losing it in taxes. You have to have something there to compound. Today we spent a lot of time, you and I, looking at market history, right? Looking at what actual market returns were. And the only way you made money in the S&P 500 over the last 20 years was by compounding it, because it was like 1.5% that you actually made without the dividends.
From growth.
From growth. And so if you had to take the money out to pay taxes, or you took money out to spend, or you did anything, you didn't earn anything, essentially, right?
Could have been better off in the bank at that rate.
It was insane. So it's about compounding. And think about that compounding that we talked about with the $24, right, to purchase Manhattan, and what that turns into. So it's all about compounding, and you're not able to compound if you have to pay that money in taxes.
Right, exactly, Daniel. That's an excellent point. And we're going to be talking more about that in a future show as far as the compounding and the S&P 500 and kind of like the fake news of S&P 500 and Wall Street. So you may want to take a peek at that. But we're wanting to be able to help you to be able to understand how to do this. Please don't try this at home. Like Daniel was saying, talk to your tax people about it. But one of the things that I find is that tax people are so busy at tax time preparing taxes that they don't have time to look at it from a tax standpoint. They don't have time to look at it from the bumping the bracket, as we call it. You have $20,000 that you can convert at a lower rate kind of thing. They don't have time to look at that. So if you would like a free second opinion on your taxes, some free tax planning, we can spend 15 minutes together on the phone, and I'd be glad to get to look at your taxes and to go through that with you on that front to see if you can save money. And if I can save you $1,000 or $2,000 or whatever, that will be worth the price of admission of a free phone call, right? So anyway, we'd love to offer this to you, to our radio and our podcast listeners. And so you can ask for the tax second opinion, when you call 800-725-7616. Also, we have the white paper, How to Give and Receive Charitable Contributions. And to the next 5 callers, we've got the book. We only have a limited supply, Three Blind Mice. How your tax preparer, your attorney, and your financial person should be working together to synergistically put together a tax plan that's going to work for you. You've been listening to Financial Strategies with Daniel Agemy. Today's topic is, if it's tax-free, it's for me. We hope you enjoy this. Daniel, any parting words?
People don't know what people don't know. And so that's why we're here. That's why we're having this conversation. And you need to ask the questions, right? If you don't know, start asking the questions. Am I doing the best that I can on my taxes? Am I doing the best that I can in the type of retirement plan, the type of qualified plan that I'm saving money in? Am I maximizing that funny green paper so that I can have more lifestyle chips in the future?
Excellent. Thanks, folks. Have a good week. Until next time.